The accounting cycle dictates that we analyze transactions, we journalize those transactions, and then we post them to a ledger, at which time we then prepare a series of trial balances, one of which is an adjusted trial balance, which we have done in a previous exercise. After we have a adjusted trial balance and we prepare our financial statements for the period, and remember that we must always prepare the financial statements, the adjusted financial statements, the final financial statements, the publishable financial statements. We then have to close our books and prepare for the new year. So here it says the September 30th, 2018 adjusted trial balance for Buzzies Inc. is shown below. So we're looking at September 30th, 2018. This is the adjusted trial balance. And let's notice a few things. Debits and credits do equal. We do have a beginning retained earnings here. This means that this is not the first year that they've closed their books, because remember, retained earnings is the cumulative earnings of a company since its inception. So now we're going to go about closing our books. So let's check our requirements real quick. It says prepare the September closing entries for Buzzies. By the way, since we're dealing with September 30th, 2018 as the closing date, that means we have a fiscal year. And the new year will start on October 1. After we prepare our closing entries, we're going to calculate the ending balance and retained earnings, which will almost do it for us the way we close our books, and prepare a post-closing trial balance. So this exercise takes a little bit of time. Now the post-closing trial balance is simply a trial balance with a listing of all the accounts and their balances, just like any other trial balance, except this one will not have revenues, expenses, or dividends listed on it because we are starting a new year. And that's how you know if you've closed all your temporary accounts. Remember, your temporary accounts are the red accounts, R-E-D, revenues, expenses, and dividends. Okay, so first thing that we always do is close our revenue accounts. So we have to open up our trial balance, keep that available to us, go down to where we first see revenues, and you see we have two revenue accounts. So we're going to list those two revenue accounts right here. One can be interest revenue, since I found that first, and the other one would be service revenue. It's true. I have a tendency to put the larger account first. Okay, so this is the closing date, September 30th. Our interest revenue, hang on just a second. Our interest revenue is $450. And our service revenue is $6,300. 63,000. Okay, notice that I'm debiting my revenues. That's because they have a normal credit balance and a proper credit balance. And in order to make them zero, we have to debit them for the exact amount. Now we're going to close these out to retained earnings. So we add those two up and we get 63,450. At this point, let's check our answer. Okay, we've done something wrong. What is it? Did I do my math wrong? Did I not put in the date properly? Maybe that was it. Let's check our work one more time. Yes, I put in my date and then promptly deleted it somehow. Okay, again, let's do this date right now, September 30th. And let's go ahead and close our expense accounts. But notice, expense accounts all have debit balances, so we're going to credit them. So what would be our first debit balance? Sure enough, retained earnings. Now let's leave that blank for a minute, because we will total up these expenses. And since there's multiple expenses, I like to just load them up, the accounts first. So we got salaries expense. We've got rent expense, depreciation expense, equipment. Now you can have multiple depreciation expense accounts, and sometimes you can just have one depreciation expense account. In this case, we just have one. Utilities expense and supplies expense. Don't be determined to put in another amount down here if there is not another expense account, and there isn't. So let's put in our debit amounts or our credit amounts to our expense account. So that's $28,400. $6,250, $2,100, $1,325, $775. Okay, and when we total all these up, you can either use the calculator that comes with the software in MyLab, or I recommend having a 4-function calculator right in the palm of your hand. It works so much easier. You may be comfortable with your cell phone, and that's fine as well. Except that on any kind of final exam, you're not allowed to use your cell phone, so I'd get used to using a 4-function calculator, as old school as that might be. Okay, so now our retained earnings is $38,850. Was 38,008. Hang on. $38,850. Okay, so let's check our answer again, and we're good. Okay, I want to draw your attention to something real quick. Notice that the amount that we put into retained earnings on the credit side of that account is offset by a debit amount that's set off, that offsets that credit in the retained earnings. So just picture retained earnings with $63,450 in the credit side and $38,850 on the debit side. We can see that we have a credit balance of some amount. That credit balance is the income. Okay, the last step in the closing is a very simple one. We close out the dividends. Now, dividends function a lot like expenses, but they're not expenses. It has a debit balance, so we're going to credit retained earnings for that balance. And we'll go ahead and put dividends in here since we're here. And retained earnings will be $8,400. And dividends will be $8,400. Check our answer. Okay. Now, at this point, our counts are all zero. So if we took a look at this, we didn't do anything with these accounts up here. The only thing we interacted with was retained earnings, revenues, dividends, and expenses. So all of those got closed into this number. So that is going to be one of our requirements. Okay, I'm going to close this. Let's see, I guess I need to leave it open here a little bit. Kind of gets in the way, doesn't it? Okay, select the labels and enter the amounts to calculate the ending balance and retained earnings. So we got the beginning balance of retained earnings plus revenues or net income minus dividends, right? Okay, so we can do this. Beginning retained earnings was $12,100. Our net income, we have to figure that out. Let's go back up here. That's why I pointed it out to you, $63,450 minus $38,850. So at this point, I have to use my calculator. See how much slower it is to use this. 63 minus 38,850. $24,600. So we had net income of $24,600. And then we subtract out the dividends, I recall was $8,400. And that should give us an ending balance Let's go ahead and add 12,100. That equals 36,700 minus 8,400. Now, dividends is a distribution of earnings to its stockholders. So that's all we've done here. So we've reduced our equity in this business by paying out dividends to the stockholders. So our answer is 28,300. Let's check our answer. Close this down, close that down, and check our answer. Very good. And now we're going to do a post-closing trial balance. And that's really pretty easy. We do have to remember a few things. One is what our ending retained earnings is. So everything up here, the permanent accounts remain permanent. And this is a good example of that. Cash, accounts receivable, prepaid rent, supplies, equipment, and right under equipment is accumulated depreciation. So be sure to hit the accumulated depreciation and not the depreciation. And we'll go ahead and put that balance in there right now, 3,200. Okay, so everything else, we go liabilities, which is accounts payable. Unearned service revenue, which is a liability as we've learned. Unearned service revenue, salaries payable, which is an accrued amount of salaries that has not yet been paid, and a notes payable. Okay, after notes payable, we have common stock and retained earnings, and that's it. Common stock and retained earnings. There it is. Okay, let's put in our balances. So we got cash, 4,700. Accounts receivable, 1,100. Whoops, 1,100. Prepaid rent, 2,400. Supplies is 625. Equipment is 38,000. We've already put in our accumulated depreciation. So now accounts payable, make sure you put it on the correct side. Accounts payable is 900. Unearned service revenue is 675. Salaries payable, 1,250. Notes payable is 5,000. Common stock is 7,500. No changes on these, right? That's because they're permanent accounts. Now, the only thing that has changed is that 12,100 has changed to an ending retained earnings of 28,300. Okay, at this point, if I was going to total these up, which I think I should, I would total up my debit balances first and then my credit balances, just to make sure that, because there's less of these than there are of others. So 4,700 plus 1,100 plus 2,400 plus 625 plus 38,000. And that equals 46,825. So if you trust yourself explicitly, you could put 46,825 here. Or you could take your calculator and start counting down. Minus 28,300 minus 7,500 minus 5,000 minus 1,250 minus 675 minus 900. equals 3,200. So we know it's going to 0. We're good to go. We check our answer and we are done. Okay, that's it. That's the closing process from an adjusted trial balance, closing revenues, expenses, and then dividend, calculating the new retained earnings balance, closing those accounts and producing a post-closing trial balance, and noticing that we have no temporary accounts at this point. We have all permanent accounts, and we are ready to start the new year on October 1.